All right, let's get right into it. We're going to talk about a tax strategy, a playbook, really, that the super rich use to live almost completely tax-free. It's called buy, borrow, die. Now, this might sound completely wild, but it's true. Some of the wealthiest people on Earth, think Elon Musk, have actually managed to pay $0 in federal income tax in certain years. And he's not alone. Jeff Bezos did the same thing back in 2007 and 2011. But here's the real kicker. This isn't some illegal, shady scheme we're talking about. Nope. What they're doing is 100% legal. They're just using the rules that are already written right into the tax code.
So how? How is this even possible? How can someone with billions and billions of dollars in wealth end up with a smaller tax bill than, say, the person who serves them coffee in the morning? That's the big question we're going to answer.
Well, the answer is a surprisingly simple three-word strategy. It's a playbook that the ultra-wealthy have just perfected, and it's called buy, borrow, die. It really comes down to three basic steps. First, you buy assets that go up in value. Second, you borrow against those assets when you need cash. And third, well, you die. And that's how you pass the wealth on completely tax-free. It sounds simple, right? But the implications are just massive.
All right, let's dig into step one, buy. The whole idea here is to get your hands on assets that are going to grow in value over time. We're talking stocks, real estate, entire companies, you name it. The key, and this is the key, is to never, ever sell them. See, your wealth is growing on paper, but because you don't sell, you never have a taxable event. The U.S. tax system is really set up to tax realized gains. So as long as you just hold on, you don't know a dime.
Okay, so you've got all these assets, but you need cash to live, right? That brings us to step two, borrow. Instead of selling your assets and getting hit with a huge capital gains tax bill, you just walk into a bank, usually a private one, and take out a loan. You use your massive portfolio as collateral. And here is the magic trick, the central loophole. A loan doesn't count as income. And if it's not income, it's not taxed. Boom. You've got millions in cash, completely tax-free.
And that brings us to the final step, die. Now, this is where things get really, really wild. When you pass away, your kids or whoever inherits your assets gets something called a stepped-up basis. What does that mean? It means the IRS basically hits a reset button. The original cost of the asset gets stepped up to whatever its value is on the day you die. All those decades of growth, all those unrealized capital gains, poof, they're just wiped off the books for tax purposes. That tax bill is never, ever paid.
So you might be wondering, what's the actual financial impact of all this? Let's look at the numbers, because when you see how uninterrupted compounding works, without taxes getting in the way, you really start to understand how massive fortunes are built.
So here's a little side-by-side comparison. Imagine two people, both starting with a $10 million portfolio. The person on the left takes the traditional route. They sell some assets whenever they need money, and they pay capital gains tax every single time. But the person on the right? They use the buy, borrow, die approach. They never sell. They just borrow what they need and let that entire $10 million portfolio keep growing and growing and growing.
Okay, fast forward 30 years. What's the difference? A jaw-dropping $62 million. That's it. That's the cost of paying taxes versus letting your money grow at full speed, totally uninterrupted. I mean, the math here just doesn't lie. This strategy isn't just a little better, it's exponentially more powerful. And look, this isn't just some theory you'd find in a textbook. Let's talk about the real world, because the ultra-wealthy are using this exact strategy every single day.
Check this out. This data comes from a massive investigation by ProPublica, and what they found is pretty incredible. Between 2014 and 2018, when you look at Warren Buffett's wealth growth, his true tax rate was just 0.10%. For Jeff Bezos, it was under 1%. Elon Musk, 3.27%. So how'd they pull that off? Simple. They take almost no salary, which would be taxed, and instead just borrow against their stock portfolios, which are exploding in value.
Okay, so right about now, you're probably thinking, sure, this is great for billionaires, but what does this have to do with me? Well, the truth is, you can actually start using smaller versions of this same strategy once you reach certain levels of wealth. Let's break down how it works at different net worths. Let's say your net worth is somewhere in the ballpark of $500,000 to $2 million. You can actually get started. Big brokerages, like Schwab or Fidelity, they offer something called a securities-backed line of credit. So think about it. Instead of selling a bunch of stock to get a down payment for a house and paying all those capital gains taxes, you can just borrow against your portfolio. That way your investments stay in the market, continuing to compound. Now, once you get past that $2 million mark, this whole strategy really kicks into high gear. You start getting access to much better loan rates, usually somewhere between 3 and 5%. And at that point, you can start funding some pretty major lifestyle expenses just by borrowing, all while your core assets just keep growing completely untouched.
And then, once you're at $10 million or more, that's when you can go all in. You're playing the full buy, borrow, die game. This is where you get access to private banking, the absolute rock-bottom interest rates, we're talking 2 to 3%, and all the fancy estate planning that makes the die part of the strategy work perfectly to transfer wealth from one generation to the next.
But, and this is a big but, is this whole thing foolproof? Absolutely not. There are some serious risks you have to think about. I mean, what if the market crashes? You can get a margin call, which would force you to sell your assets at the absolute worst possible time. What if interest rates shoot up? If your loan costs more than your portfolio is growing, the whole thing falls apart. And of course, there's always the big one. Politicians could just change the laws and close these loopholes, especially that stepped-up basis.
So all of this leads to a pretty big and pretty important question, doesn't it? Is this system that allows for this fair, or is there something fundamentally flawed here? Well, there are really two ways to look at it. The argument for it goes something like this. The wealthy are just legally minimizing their taxes, which anyone would do. They're playing by the rules that the government itself created. So if you don't like the game, you should focus on changing the rules, not hating the player. But the argument against it is that this creates a two-tiered system that's just fundamentally unjust. You have one set of rules for the wealthy, whose wealth grows tax-free, and another for everyone else, whose hard-earned income from labor gets taxed heavily.
When you really boil it all down, what this reveals is a totally different way of thinking about money. It shows that at the highest levels of wealth, the game isn't about earning a bigger paycheck. It's about accumulating assets and then just never, ever selling them.
And that really leaves us with one last big question to chew on. Is our tax system actually built to tax wealth? You know, the kind that's tied up in assets that are never sold. Or is it really just built to tax income, the money that most of us rely on just to get by? It's definitely something to think about.